Good afternoon, and welcome to the AFS Best Practices Leadership Webinar. Thank you for joining us today. Our topic is real-time payments. What does it mean for commercial lending? This webinar will be approximately an hour long, and our speaker today is Lee Kidder. Before we get started, there are a few reminders for today's event. We encourage questions, so please use the Q&A feature to ask your questions. We'll leave some time at the end of our prepared remarks to answer as many questions as possible. We are recording today's session, and tomorrow you will receive an email with a link to listen or download the presentation. Thank you for joining us again, and Lee, over to you.
Thank you very much, Renee. Good afternoon, everyone. Welcome to our webinar presentation, and thank you for taking the time to join us. AFS, as I don't need to tell anyone, is a company dedicated and devoted for 50 years to the commercial lending industry. We eat, sleep, and breathe commercial lending, which has long been one of the premier revenue-generating lines of business at banks. But today I want to zoom out a little bit and talk about commercial lending in the broader context of another major revenue maker at banks, and that's payments. Why payments? Well, for one thing, payments in the minds of many people represent the core activity of banking in terms of both volume and value. McKinsey, in its most recent global payments report, estimated global payments revenue in 2018 at $1.9 trillion, amounting to nearly 40% of total banking revenues. Depending on which payments technology vendor you rely on, they've estimated that there were somewhere between 700 billion and 1 trillion payment transactions in 2020. Another reason, more to the point of today's webinar, is that there's a big change taking place in payments in the United States with the advent and growth of so-called real-time payments, or faster payments, or immediate payments. Real-time payments have been around for a few years already, but their uptake has only in the past year begun to take off, propelled by the momentum of digital transformation and accelerated by the COVID-19 pandemic. A third reason, which gets at an even larger trend in banking, is that payments, and especially real-time payments as we go into the future, are the lifeblood of a digital banking system that's directed toward delivering a superior customer experience, one that is immediate, personalized, and up to the minute. So I want to talk today about real-time payments, and particularly about how they'll interact with commercial lending, because I don't think they really yet have caught hold of the imagination of the lending industry. They will soon, they have to, because of their role in connecting the systems of banking ecosystems. These broader, more integrated ecosystems are taking over banking architectures, thanks to APIs, the cloud, and other digital factors, and imposing new expectations and requirements for connectivity on individual systems. No longer can systems be evaluated on their technological functionality in isolation, as if they operate in a vacuum. The question banks are asking when evaluating a new commercial lending system is no longer just how well does it perform accruals, but even more, how well will it integrate into our ecosystem? So this webinar will present a brief overview of real-time payments, but really only as a prologue to a discussion of how they will operate in the broader context of commercial lending and the entire ecosystem of corporate banking, and why the integration of all the elements of that ecosystem is so critical. Finally, we'll identify a number of potential use cases that show the benefit of RTP, real-time payments, for corporate and small business customers, but also the value and benefit in return for corporate banking systems, including especially commercial lending, of incorporating real-time payment capabilities into their operations. So here we go. Remember the poem by John Donne entitled "No Man is an Island"? Well, that applies to the banking environment too, and especially so when we talk about digital transformation. In fact, this concept of connectivity really is a defining proposition of the digital age. Lines of business and systems can no longer operate as standalone entities. In the digital world, lines of business and their systems must all be connected because they all belong to a new customer-centric universe in which they all interact with and affect each other in real time, in the cloud, through APIs and web services, delivering up-to-the-minute data, information, and analysis. Banking, like other industries, has borrowed the term ecosystem to describe this new phenomenon, and it serves as an excellent metaphor to describe the connections between commercial lending, payments, and other banking services. What do I mean by ecosystems in banking, and what do they have to do with payments? Well, I expect most everyone on the call had a biology course in high school, and you probably remember the term ecosystem as being something like this picture. National Geographic defines an ecosystem as a community of living organisms in conjunction with their physical environment, interacting as a system. These components are linked together through nutrient cycles and energy flows. Now think about what an ecosystem really is in basic terms. It's a holistic system with a number of distinct components or participants. Each of them represents a unique function, but they all interact with each other interdependently in ways that contribute to the greater overall health of the whole. The absence of any one element can actually weaken the whole ecosystem. Now think about that concept as a way to describe the system environment that's coming into place for corporate banking. Substitute APIs for nutrient cycles and payments flows for energy flows, and we're on to something, as you can see in the updated definition at the bottom of the slide. This diagram represents in simple terms why the term ecosystem is a perfect metaphor to describe those relationships. Actually, what this diagram shows is two ecosystems that are closely related to each other, flip sides of the corporate banking coin. Look at the group on the left. For a given company, there is a group of people or companies that they typically interact with closely on a regular or daily basis. Think of them as that company's regular ecosystem: suppliers, customers, employees, etc. Banks are one element of that ecosystem, an important one to be sure, but one that has to operate harmoniously with all the others to make that company successful. Now follow the red line connecting that company to its bank, or one of its banks, on the right. That little group represents ABC Company's banking ecosystem of corporate banking services, as we think all of them will mostly will exist soon. All in the cloud, of course, and accessible through a single sign-on portal. These are the core functions and services that a typical corporate customer would utilize from its bank as its working capital needs demand for cash flow, payments, credit, account management, and so forth. And this is the bank ecosystem, all operating harmoniously internally, that then operates within the company's own ecosystem on the left. Why this little cluster on the right is so important is that banks no longer can see themselves as selling individual financial products to their corporate customers, but rather as providing value-added services through a digital ecosystem such as this one, focused on the customer experience. Each element in this ecosystem has its own product or service to provide, but what will differentiate a bank from its peers is how effectively each element works in harmony with the others to form what I like to call a symbiotic delivery system. The whole is greater than the sum of its parts. A good ecosystem will have a number of support features, such as cloud-based, digital and mobile delivery, real-time processing, and APIs and web services with standards-based connectivity. Probably every one of us can tell a horror story as a customer in a situation where a company's service delivery had a breakdown, and the resolution of that problem, which should have been routine and digital, soured the entire experience. I heard just this week of an incident experienced by one of my AFS colleagues, where a check deposit in an ATM went bad when the ATM ate the check. My colleague was told she had to produce, quote, evidence of the deposit. Now, mind you, the evidence was inside the ATM, and things went from bad to worse there. The resolution of her incident was decidedly non-digital and covered 9 service people at the bank, multiple internal and external systems, and 11 weeks to complete. The service ecosystem simply wasn't able to handle the exception. Which brings me to a really critical point about these ecosystems. For any ecosystem, financial, environmental, cosmic, or otherwise, to operate effectively, it must necessarily include the elements and the means to respond to the needs of customers, users, or inhabitants. Operating harmoniously among the permanent participants in the ecosystem is necessary but insufficient. That harmony must also extend to and incorporate any temporary participants. This will include, in our case, possibly some non-bank players, fintechs, integrators, aggregators, monolines, and so forth. That point becomes especially critical when we talk about payments for this reason. Unlike most other financial transactions, which affect only a single customer, payments are a two-party phenomenon. Each payment involves a sender or payer and a recipient or payee. In order for a single payment to be considered successful, both parties must walk away satisfied that their respective needs have been fulfilled. That can become complicated if the two parties are thousands of miles apart, relying upon different banks, different systems, and with different priorities for that payment. Finally, now, note that payments are at the center of the bank ecosystem on the right, which gets to one of this webinar's key messages. Think about all the many transactions, interactions, data flows, and other activities that will happen in the course of a banking day. The predominant activity that's behind them, drives them, and is the subject matter of most financial data reporting is payments. Payments are the principal transactional factor in corporate banking activity and hence in ecosystems. If you get right down to it, payments are the reason that most banking activity happens. A lot of analysts, including McKinsey, say that payments account for about 40 to 50% of all banking revenue. They're the overwhelming factor in system integrations, workflows, data flows, and access to corporate systems like cash management, loan servicing, trade finance, and wealth management. Credit, commercial lending, is critical, obviously, as either a direct or indirect source of liquidity and funding for payments. All these systems will be evaluated in large part on their capabilities to integrate and engage with payments. And given what we were just talking about, the payments in these ecosystems are necessarily going to be real-time payments. All these systems will need to be able to handle real-time payments in real time, or else for the value proposition of the whole ecosystem breaks down for its customers. So this has been a lengthy prologue, but what really is a real-time payment and what makes it so different and special? That's actually a good question because the answer is a bit more involved than a lot of people might think. Yes, the obvious fact is that the payment happens in, quote, real time, and the recipient gets money immediately. But getting money and being able to use money aren't necessarily the same thing. Some payments happen right away or on the same day, but availability, being able to use and spend money, may not happen until overnight or even 2 days later. That's because it can take that long for the two banks involved in a payment to settle with each other. A real-time payment involves several necessary elements. One, the transaction completes immediately or nearly immediately, no matter whether it's coming from next door or halfway around the world. And notification that confirms that completion goes immediately to both parties, payer and payee. 3, the funds are available immediately. The payee's account receives good funds seconds or minutes after the payment is made and can spend that money seconds or minutes after that. 4, very important, the payment is certain. That means it's final, settlement is completed, and no one can reverse or take it back. And finally, the service needs to be available to use 24/7 by 365, so that it genuinely is real time, weekends, holidays, birthdays, night or day. This feature, my good friend at the clearinghouse tells me, is actually just as important as immediacy because it eliminates the possibility of backups if a service is unavailable, which then clog the pipes when it does open, delaying the completion of payments. In this regard, you may have heard or read the term faster payments, which are almost, but not quite, the same thing as real-time payments. The critical difference, which really is invisible to the payer and payee, involves when the settlement transfer that finalizes the payment occurs between banks. In a real-time payment, the transfer of final funds, the settlement, occurs simultaneously with the transmission of the payment message, and just before funds are made available to the payee. This is called RTGS, real-time gross settlement, where payments are settled one at a time as they occur, as opposed to a net batch settlement sometime later. In a faster payment, the settlement is deferred, meaning it occurs after the payment is made available to the payee, usually by just a few minutes, but potentially up to a day or longer. This creates a hypothetical credit risk to the payee's bank and is the important distinction between the payment types. Here's a set of some of the more generic benefits that accrue from real-time payments. And a very interesting thing to note is that the way things are developing, the obvious and immediate benefits, such as I've just discussed, immediacy, availability, finality, etc., aren't going to be the only ones. In fact, the clearinghouse, which manages the RTP network, has said publicly that the long-term winners in real-time payments will not be the institutions that remain focused solely on improvements with payment systems themselves, but will be those that are providing innovative enhancements and value-added features to the customer interactions. That's what the quote from Swift is about. Swift is in the process of upgrading its payments platform with many of these same extra benefits and has said its goal is to, quote, turn a payment from a message into a conversation. One of the most talked about new features is called request for payment, a message type on these networks that is exactly that, a request amounting to an electronic invoice for funds due from another party, which can contain data about the invoice, transaction, and other details, and then can be paid by returning the message with payment information. There would be a small fee associated with this service, but it will greatly improve the efficiency and timing of accounts receivable and payable operations. Richer data will be a result of the fact that these networks either employ now or are in the process of transitioning to a schematic format known as ISO 20022, a new global standard for payment message definitions and formatting, which will standardize message processing as they cross borders and payment systems, and will permit a much richer and fuller amount of information on payment messages. ISO 20022 will be mandatory on all the major payment systems in the next few years. These payments can actually provide a macroeconomic benefit also by reducing what's called transaction float, that amount of money that seems to be in two places at once, while payments are taking a day or two or three to clear and settle. With real-time payments, this money will circulate in the economy that much sooner, thereby improving liquidity and cash flow. I want to emphasize again, going back to what I said a minute ago about the two-party aspect of payments, that these benefits apply in like measure to payer, payee, and often their respective financial institutions. If all parties are not benefiting from these expectations, real-time payments will be a flash in the pan. Care and attention are going to need to be paid at all points in the process to make sure they are successful. Real-time payments have grown tremendously in the past few years and are poised for even greater growth to come. 70 billion real-time payments globally last year, a 41% growth over the year before, obviously accelerated by the pandemic, but still only about 10% of all global payments in 2020. The US is playing catch up with the rest of the world, where there are about 50 real-time or faster payment networks in operation. These three that you see here, one of which is still in development, are considered the true real-time networks in the US, and I'm focusing on them for today's purposes. RTP, real-time payments, is the network owned and operated by the clearinghouse and where most B2B, business-to-business, real-time payments are run. It began operations in late 2017 and now runs hundreds of thousands of payments daily, millions annually. The clearinghouse doesn't yet publish its actual numbers. Over 100 financial institutions can connect now to RTP directly, but hundreds, or perhaps thousands, have the capability to receive payments through connecting processors that connect them to the RTP network through their own networks. By virtue of the fact that the banks behind the clearinghouse are most of the largest in the country, the network has access now to approximately 70% of all DDA accounts in the country. The number of institutions and firms connected to RTP is growing rapidly, and just last week, RTP announced new programs to enhance bill payment and increase access for minority institutions. Zelle, which is owned by Early Warning Services, which in turn is owned by 7 of the largest banks, is predominantly a network for low-dollar P2P, person-to-person payments. It also began in 2017 and now has about 750 institutions offering it. Users sign up for Zelle through their bank's online banking service by connecting their checking account information when they do it for the first time, but thereafter the flow is automatic. Zelle can also be used on mobile apps using phone numbers if one's bank does not offer the Zelle service. FedNow is the real-time network being developed by the Federal Reserve and is scheduled to go live sometime in 2023. In January this year, it began a pilot testing program which has over 100 participants across the country. It will operate much like RTP, and its aim is to ensure real-time capability for banks of all sizes. Smaller banks had wanted there to be a competitor to RTP to ensure that access for all. Now, where these and other networks are concerned, there are several priorities that they want in order to be fully successful. One is ubiquity, to be able to provide the capability to reach any account at any institution across the country. Interoperability, to be able to pass and forward messages seamlessly across networks for coverage and reach. Standardization, to eliminate errors, exceptions, and delays caused by incompatible rules or formats between networks. And open banking connectivity, to simplify and standardize technical requirements for connection. ISO 20022, as I mentioned on the previous slide, will be mandatory in a few years on all major payment networks. It's important that banks will need to become knowledgeable and conversant about expectations coming their way about usage, implications, and timing for that new format. This slide is really just an add-on to some of the stats I just mentioned about the RTP network. It displays the different payment types that are being sent over the network, and in my conversations with the clearinghouse, I'm told that they are analyzing this information with keen interest to see what types are becoming the most frequent users of the RTP network. Some have become unexpectedly strong users. Right now, there are 3 types with some of the heaviest volumes of transaction: payrolls, payments for gig economy workers, and merchant funding, which seems to have become a real boon for merchants who can now get funded much more quickly for their credit card payments, even on weekends. So now we've come to the $64,000 question. What does all this really have to do with commercial lending? Why should commercial lending really need to be concerned about real-time payments, which are the province of, quote, another business department? What are the connections and potential interactions and benefits? First, go back to the slides where I talked about the growing role of banking ecosystems and the need, nay, the price of admission, that participating systems must interact effectively and efficiently with each other. The ecosystem will not survive otherwise, and that means each system's line of business will have to understand these new rules of engagement. Since payments will be the, quote, energy flow of those ecosystems, it will behoove every system involved to be conversant, knowledgeable, and integrated as closely possible with the new real-time needs of the others. Loan systems, for example, will be expected to release outgoing advances in real time, not in scheduled batches, to meet those requirements. Second, as I mentioned a few slides ago, real-time payments can become a value-added experience, even for credit customers. Cases that come to mind are the opportunity for immediate available funding of loan advances, especially for small businesses, and especially those going to external DDA accounts, where the receiving bank may not always provide immediate availability for all deposits. Another would be immediate funding for loans that are designated for open trade finance accounts, factoring, or merchant funding. And third, what I mean by the first bullet here is that asking what real-time payments mean to commercial lending can be turned around to consider how uses in commercial lending can enhance and expand the value proposition of real-time payments. The role and benefit of commercial lending as a critical contributor to a payments-driven ecosystem increases the flexibility and value proposition of that ecosystem to a customer. But this in turn mandates appropriate integration, linkages, and consistent data formats among several systems. A number of people have asked me what the potential use cases would be for real-time payments in a commercial lending setting, and I think I've covered a number of them already. An interesting thing that's developing in that regard is the level of innovation that's already being applied to these payment types, and the many opportunities for further information, all in the name of enhancing the customer experience. The quote rails for these payments, the networks they travel over, are obviously the important enablers for their speed and immediacy, but the coming benefits are going to be in additional services. Someone in one of the articles I read said that, quote, payments are most transformative when they transform something else, which I think is a great soundbite for that proposition. Payments, after all, are simply a means to accomplish some other objective, and their real value lies in how smoothly and how conveniently that objective can be fulfilled. Real-time payments are the vehicles that fulfill a great deal of the promise of real-time banking for customers, both commercial and consumer. In that sense, use cases for a commercial lending environment can be divided into two types. One where the beneficial impact is more direct and specifically affects lending products and services, like some that are listed here. Request to pay for syndication advances, for example. The distribution of payments coming in for syndicated loans, factoring and reverse factoring, which really involve receivables and payments financing, and construction and project lending are all amenable to real-time payments value. To the extent that any payments need to be made at whatever time of day or night to meet a business need, the commercial loan line of credit can provide the available funds, provided, of course, and this is very important, that the loan system itself also operates in real time. And then the second category of types would be those indirect use cases where the commercial credit facility is the funding source for other corporate banking transactions or services. Other corporate functions like trade finance, merchant funding, supply chain finance, and cash concentration can all benefit by the use of real-time payments, and the further implications of those integrations can result in many of the attributes listed below them. One new feature that might emerge in commercial lending, for example, could be just-in-time liquidity spigots that would support emergency or last-minute funding needs. So what can banks be doing in the near term to become better prepared for the all-time payment future, the real-time payment future? Probably the most important task I would recommend is to develop or perfect a payment strategy to cover real-time payments. How do you want to incorporate real-time payments into your payment services? What network or networks would you expect to join, and based on what criteria? What factors do you want to promote, especially with real-time payments? Speed, convenience, security, value adds. And as part of that strategy, become conversant with ISO 20022 as the new standard for payments messaging, and the many data enhancements that can offer in the form of new revenue opportunities. Think about the potential impact of real-time payments on cash flows and liquidity. It's possible that the elimination of payment float and the contraction of lending float could have implications for interest income. And finally, think about where the innovative benefits from real-time payment adoption are going to come from. Not so much from tinkering with an existing payment system, but more from focusing on what is happening with customers at the point of their interface. In other words, make payments an experience for the customer, with new features and services layered on top of the basic payments. So let's close up by tying together the threads we've been talking about today. I think we've had 4 or 5 separate channels. 1, you may have heard about real-time payments, but wonder what they really have to do with commercial lending. 2, a commercial loan system will have to operate in tandem with several other systems that serve as corporate banking, all in an ecosystem environment at a bank. No line of business is an island, remember. 3, in order to thrive and survive in today's competitive world, all of that has to happen in a digital mobile environment that's in the cloud, interconnected, integrated with APIs, and operating in real time. 4, payments are likely to be the function that will drive most of the activity and interactions in such an ecosystem. And last, those payments will naturally need to be real-time payments, or else the ecosystem will get gummed up to a fairly well. Net, will real-time payments be an absolute game changer for commercial lending? No, they won't, although they will provide several direct benefits to the lending process that I've mentioned. But they will make commercial lending a more inclusive and better integrated player in a corporate banking ecosystem by providing a more holistic and flexible value proposition to customers as a funding source and potentially a significant source of revenue as commercial loan accounts become more engaged in the everyday transactions and payment flows of working capital. Commercial loan systems, for their part, will need to be able to handle all the capabilities I've talked about here. And of all of them, the one that's most critical is real time. The system will have to do its processing in real time, and given the importance we believe payments are going to have in the new corporate banking ecosystem, it will absolutely need to be able to manage real-time payments. As my closing statement, I'll just mention that the only system that can do all of that is AFS Vision. Check it out. So that concludes my formal remarks this afternoon. I'll be happy to try to answer any questions that may arise. And Renee, I'll turn it back to you for some further announcements.
Thanks, Lee. While we wait for a few moments to see if anyone has any questions, AFS would like to remind you that we have several webinars coming up for the rest of this month. We are having a roundtable with capital market advisors next week on the 19th of May in regards to the LIBOR replacement transition coming. So if that is something of interest, please be sure to register for that. Additionally, we are going to be doing a webinar in regards to 1 year later and COVID's impact on commercial lending. And that will be next week as well on Thursday, May 20th. And then we have a few other webinars, as you see listed here. All are described on our website. And once you get the deck, you'll be able to push the register now, and it'll take you right away to the registration section on our website. With that, Lee, it doesn't look like we have any questions. So we'd like to just thank everybody for attending. We will be sending out a link so that you may listen to this and or download the materials, as well as share it with a colleague. So thank you all and have a good day.